Well, hi everyone, and welcome to the Buffett and Beyond ETF Sector Stars. So, folks, we have a portfolio out there. We've been calling it the triple ETF. We've been calling it the best ETF. Anyway, now we're calling it the ETF Sector Stars, and this is all because you folks have been sending in various names for the portfolio of ETF stocks that we have comprised of. Now, what are our goals here, and how do we do this? Number one, the portfolio that we put together, right now it has 18 stocks in it. It's comprised of the highest clean surplus ROE stocks of tech, semiconductor, the QQQs, and remember the QQQs are the NASDAQ 100 largest stocks minus the financial stocks. And we are basing this on a strategy we've been using for 22 years now. There's a book written on it, doctoral dissertation, and over 22 years our portfolios have outperformed on a compounded basis 3-to-1 the S&P 500. Now remember, 96% of professional money managers cannot outperform the S&P 500. We're doing it on a compounded basis, almost 3-to-1. All right, we want the ability, number two here, we want the ability to systematically hedge the portfolio, reduce the risk, because this portfolio has more risk than the S&P 500. Why take on more risk? Because we want to reduce risk but outperform the S&P 500. We want to generate cash as the market declines. Why? Because this allows us to have buying power at market bottoms. Because everybody says, oh my God, the market went down 22%, 30%, 33%, and I wish I had money to buy Meta. I wish I had money to buy Google and Apple. Well, this gives you the money to do that because the hedges make money as the market goes down. Toward the bottom of the market, when you think you're there, you don't have to be right on the bottom, but close to it, you have the money to cash in those hedges, buy more stock. Now, where do we go for our best returns? Well, the black line is the S&P 500 over the past 5 years, and this mustard-colored line is the QQQs. And the QQQs, again, NASDAQ 100 stocks minus the financial stocks. NASDAQ 100 biggest stocks. So you got your Microsoft, you got your Metas in there, you got your Googles, you got your Apples. So those are the stocks that we're looking at, and we can see the QQQs have outperformed the S&P 500 by double. But look at here in 2022 when the market went down. The S&P went down 19.4%. The QQQs went down about 33%. So, folks, that's a hard road to handle. Even 19% was hard to handle because I heard a lot of screams coming in through our newsletter. Now, what about ETFs? We were going into ETFs many years ago. They weren't popular. They became more popular. And so we started our ETFs about 2015 or so. So we've been in it almost 9 years now. And we are looking at the ETFs. Again, black line is the S&P 500. And the ETFs we follow, we want to pick a portfolio of stocks that really reflect a lot of the technology out there, because let's get on the bandwagon, folks. Technology has been the leader in most areas for the past 140 years, so we might as well be there with them. So why don't we look at the ETFs that have been outperforming the S&P 500 over the past 5 years? And as you can guess, in these four areas that we have here, we have semiconductors up here. Again, black line S&P 500. Semiconductors almost 2.5-to-1. Tech sector almost 2.5-to-1. The QQQs, the housing industry is also or the home builders, I should say, also following this trend line of the QQQs. So why not take stocks from the portfolios or from the ETFs that are outperforming the S&P 500. Why? Because those are the ETFs that contain the stocks that are outperforming the S&P 500. It's that simple. So we go primarily to these areas, and mostly the tech, semiconductor, QQQs, a couple, one or two from the stocks, and we even have one or two from transportation in there, which are excellent stocks. So let us go to see what we're going to do about hedging the portfolios, and we're looking at just this year. So we're looking at 1 month and 9 days. So this was as of just on Friday during midday on February 9th. Now, the QQQs, we're using that as our benchmark, and we're using that as our hedge. QQQs were up 6.5%. The S&P 500 is up 4.9%, and our portfolio of 18 stocks, now they're not all listed here because we don't have room on this, but our portfolio consists of 18 stocks right now. They are up 13.6%. They're doubling the QQQs and almost tripling the S&P 500. So, as is expected, our top stocks are outperforming not only the S&P 500, but also the ETF index itself. Now, how do we get rid of some of the risk in the portfolio? And I'm going to show you some more charts as we go along. Let's say we bought the inverse SQQQ. That means short the SQQQ 3 times the inverse. So if you invest 10% of your portfolio value, whatever you put into these stocks, take 10% of it, buy the SQQ, which is 3 times the average, and you will be 30% hedged. So you have 90% of your money going into these stocks. You have 10% of your money going into buying the SQQQ ETF, which is 3 times the QQQ. So for 10%, you get a 30% hedge. Isn't that nice? It still leaves you 90% to buy those stocks. So if the top stocks returned 13.6% over the past 5 weeks or so, if you invested 90% of your money in these top stocks, you would have returned 12%. Not bad, folks, since the S&P is up only 4.9%. But you lost 2% on your hedge. 1/3 of the 6.5 is a little over 2%. So you made 12%, you lost 2%, your profit is 10.3%. Still more than doubling the S&P 500 by a tad. Well, what if you were 50% hedged? Then you need to use 15.5% of your money to buy enough hedges to be 50% hedged. But it still gives you 84.5% to buy these 18 stocks. So if you're 3 times hedged, you would have lost 3.3% on the hedge because the market went up, the QQQs went up. But you gained 11.5% in your stocks. So gained 11.5%, lost 3.3%. So not, but you're 50% hedged, so you gained 8.2%, still almost doubling the S&P 500. If you were 100% hedged, we're going through the same thing, you would have made 9.1% on your 18 stocks. You would have lost 6.5% on your hedge. You're up 2.6%. Okay, that's nice. So right away, where do our eyes go? Either 30% hedged or 50% hedged, doesn't it? Because we're outperforming the S&P 500 while we are also hedging some of our portfolio. But how much are we hedging? We're going to get to that. All right, let's go to 2023, which was a phenomenal year. Why? Because 2022 was such a lousy year. So 2023, the market came roaring back. QQQs gained 53.8%, S&P 24.2%, and our top stocks gained 85.6%. So, folks, we're really rocking in here. Well, okay, let's go through this. If we want to hedge 30%, we're going to have to buy 10%, use 10% of our portfolio to buy the SQQQ ETF. You got to get enough Qs in there, folks. And so that is 3 times the inverse QQQs. So the QQQs go up, this goes down. The QQQs go down, this goes up. So we needed 10% to buy the SQQs to be 30% hedged. And that leaves us 90% to buy the stocks. You know where we're going. We lost 35% on our hedge. This is over the whole year of 2023, we lost 35.8% on our hedge, but we gained 77% on our stocks. So overall, we gained 41.2%, just about doubling the S&P 500 up here. 50% hedged, we would have gained after losing money on our hedge because the market went up. We gained money on our 18 stocks because the market went up. And so we gained 72%, lost almost 27%. So overall, we gained 45%. Now, for 100% hedged, go through the same process, we would have gained only 3.3%. So let's go to 2022 when the market was terrible. QQQs lost 33%. S&P lost 19.4%. Our top stocks lost 36%. So when you put it all together, the hedging, buying the stocks and losing on the stocks, we gained 9.9%. This is if we're a third hedged. We gained 9.9%. because the market went down. We lost 32% because our stocks went down. So overall, we lost 22.5%, pretty close to the S&P 500. 50% hedged, well, go through the same schematics here, and we lost 13.9% overall, while the overall market lost 19%. The QQQs lost 33%. Now, that's what I was talking about when we go back to that first chart, and it's this area in here that lost 33%. This is the QQQs, while the market itself, the S&P, lost 19.4%. So we're trying to protect against this kind of decline. It's hard to take. So here we are. We lost 13.9% by being 50% hedged. And if we were 100% hedged, we actually gained 9.1%. All right, that's pretty good, folks. Gained 9.1% if we were 100% hedged, but we don't make much on the upside. We're going to see a chart of that. All right, let's go to 2021. And 2021 was a good year. The S&P gained 26%, 27%. QQQs gained 31%. If we were 30% hedged, which means we needed 10% of our portfolio money to buy the SQQQ, because it's triple the inverse. You invest 10%, you get a 30% leverage on this SQQQ. Well, with the market gaining, we would have lost 10.3% on our hedged, but we gained 49% on our stocks. Again, this is 2021. So overall, we gained 38%. And 50% hedged, all in all, we would have gained 30%. 100% hedged, we would have gained 5%. Now, it's hard to sit there gaining only 5% because the market was up 26.9%. QQQ's up 31%. So we're looking at this askew a little bit, but we're going to see the results here in a second. All right, now let's put all this together. Now, these are the compounded returns. If you invested money in the beginning of 2021, these are the compounded returns. And let's keep our eyes on the 30% hedged. Here's the hedges, 30% hedged and the 50% hedge. Okay? So during 2022, and this is why we're even talking about hedges, during 2022, NASDAQ lost 33%, and we actually lost, our portfolio lost 36%. But look at the return we made in 2023. So yeah, now you're putting these together. So 2021, this is zero hedges. These are just our long stocks. We gained 53%, 54%, 21, lost 36%, 22, gained 85 in 2023. And this year, so far in 5 weeks, we gained 13.6%. So compounded. If you put this on a compounded table, or if you just invested at the beginning of 2021, you made 108% on your money. Now let us look at the hedges for 30% hedged and 50% hedged. During 2022, 30% hedged lost a little bit more than the market. Here's the market down here in yellow. So the market lost 19.4%. And don't forget, the QQQs lost 33%. So 30% hedge, we lost 22.5%, which is palatable. 50% hedge, we lost 13.9%. So we're comparing it with the S&P 500. And if we were 100% hedged, we actually made 9.1%. So we're looking at that. But then 2023, we came roaring back, and you can see the numbers. And let's keep our eyes on here. Why are we looking at 30%, 50% hedged? Because compounded over these 3 years and 5 weeks, so 21, 22, 23, and first 5 weeks of 2024, compounded, the S&P is up 33%, but you had this 19% decline, and if you were in the NASDAQ or the QQQs, you lost over 30%. Now, compounded with 100% hedged, you gained 21%. That's not too bad, even though we're looking at low numbers, and that's because 2022, we actually made money when everybody else lost money. Now, here's the 30% and the 50%. We gained 76% compounded, 50% hedged, and we gained 67% if we were 30% hedged. Much, much better than the S&P 500. And what was the risk? Well, the risk was around in 50% hedged, less than the S&P 500, 30% hedged, a little bit more than the S&P 500. But look at the returns relative to the S&P 500. So we're looking at hedging. Now, you don't have to hedge, folks. You could have made some serious money, triple the S&P 500. Yes, absolutely triple the S&P 500. You would have had to sit through a 36% decline, which is hard to see a third of your money evaporate. But some of you can stand that. You say, hey, I could stand the risk because I'm going to leave money in for a long time, so I can stand that 36% decline in there because look at the returns we get sooner or later. And this is the past 5 years. So, folks, the future is no indicator, or the past is no indicator of the future. So we're looking at the numbers here, real numbers, but they are numbers that may or may not occur again. So we're kind of looking at the 30% hedged or 50% hedged, where you are exposed to market declines. 50% hedge, you're exposed less, but your return is 76% compounded, which is pretty good because we had a good year in 2023. So that gave us that extra boost to get us more than actually being 30% hedged. But right in here is seems very doable. And a lot of you are asking about, hey, I want to be 30% hedged because I'm only using 10% of my portfolio money. I'm not going short. I don't have to worry about put options. I'm hedged all the time. And yeah, I lose on my hedge when the market goes up, but my stocks go up much faster than the money I lose on my hedge because I'm long 90% of that market portfolio of 18 stocks, and I'm only 10% short, actually 30% short, but I'm only using 10% of my money in order to be 30% short. That's what has come about in the past 10 years or so, folks, are these inverse ETFs, which are double and triple the index that they follow. So that gives us a nice way of being able to be partially hedged or fully hedged, or to be partially hedged and yet really outperform the S&P 500. And this is being fully hedged all the time, folks. It's not like trading where, hey, I'm wrong on this trade, I'm right on that trade. But you've got to understand that your hedge goes down, you lose money on the hedge when the market goes up, but you're making more money on the portfolio because you're long the portfolio. And so, folks, that's how it works. That's how the hedging works. And boy, oh boy, it's really nice when you can compound your money at double the rate of the S&P 500 and to be partially hedged in between without even having to trade. You put these on in the beginning of the year and you pretty much leave them. Yeah, quarterly we we do review the portfolios. We'll rebalance the portfolios a little bit, add a stock every now and then, take a stock away or replace a stock. So that's our portfolio, folks. And it is working very, very nicely now. Some people are hedged and they're really liking it because they say, I understand it now. It's better than going short, using margin to go short, or using S&P 500 puts. So there you go. A really, really nice way to hedge in these modern times, because the inverse ETFs are out there for our use as a hedging tool. So folks, we had a really good week this week. The market is up. The S&P is over 5,000. Can you believe it? It's Super Bowl weekend, so go out, enjoy your weekend, folks. Have a good time. Watch the football game if you want. And folks, we'll be back here on Monday. So you stay safe. We'll see you then.